Good morning, everyone. Good afternoon, good evening as well. The usual greeting. Thank you for attending today's webinar. As always, if anyone has any comments, criticisms, the often requested jokes, please type them into the Forex Street video live chat. I will be checking them periodically, and I'll be glad to answer your questions and take the webinar in any direction you'd like, at least temporarily. Once again, I'd like to thank FX Street for the facilities for doing this, and also my own company, Worldwide Markets. Our greatest interest is in providing both services and information to our clients and to the market at large, hence these webinars. I've titled today's webinar, Blame It on the Elections, or When Will Volatility Return? Now, if you've been in currency trading for a while, or put it more colloquially, as long as I have, you know certainly that there are long periods and shorter periods of decreased volatility. It's frustrating as a trader because it makes it harder to trade. There's less action, there's less participation because volatility draws participation. The interest of traders is uniform but marked in volatility and profits. But the more volatile the market, certainly over time, the more participants it attracts. We saw the best example of this, of course, the pre-financial crash run-up in oil. Phenomenal amount of volatility and phenomenal amount of participation for what had relatively been a professionals market up until that point. But it attracted all sorts of professional and additional professional and semi-professional interest. And it drove the oil price to uneconomic levels, shall we say. There was certainly nothing in the fundamentals either experienced or feared, except for maybe some very, very kind of loony fringe of the peak oil crew that justified that kind of $150 price. What was happening, and what did happen, of course, was the volatility drew participants, and the participants drove the price because they all went in the same direction. Naturally enough, when you've got a powerful trend like that, that's what happens. Well, let's take a look at what our current volatility looks like. I could also have titled this, and I thought actually, of titling this lecture. Let me just, come on, guy. I'm waiting for my screen share to come up here. Okay. Application window, there we go. VIX, this is the VIX 1 year. Okay. The VIX, of course, is not a measure of particular volatility in any market, but it is used as an overall measure. It is essentially a hedging tool. It is a index that rises and falls on its traders' perceptions, participants' perceptions of market volatility. The yellow line there is the American election, and you can see that as the election approached, the volatility soared, and right after the election, it stayed up there and then it crashed, and we've been very little volatility since then. So this looks as if we have a long-term trend, or at least a long-term instance, of lowered volatility. Let's take a look, though. Remember, this is a reasonably good overall measure of what markets are thinking and fearing. It's not a measure of any particular currency or instrument volatility, but it does correlate fairly well with overall market sentiment. Okay, so let's take a look at the long-term trend. This is the 20-year. This is actually 1992 in the VIX. Just to give you a little perspective. The word I'm looking for is perspective. And there we go. Okay. You can see when on the interim, we've installed some new computer and video and sound equipment in our in our studio here. Well, it's a studio. It's actually a conference room, but it is working fairly well as a studio. But I haven't had a chance to put the new background in, so it looks like I'm speaking in front of a great window overlooking New York. In fact, I'm in New Jersey, as I think you all know. The wonders of green screen. Nobody does it better than the movies, of course. In our family, I have two 8-year-olds. I think I've mentioned this more than once. And we are Harry Potter all the time. So if they're not reading the books themselves, we already read them to them. We are listening to Jim Dale, a British actor, read them in the car, or we are watching the movies. So it has really been quite an exposure to the capacities of computer-generated imagery, of which the green screen behind me is a most crude and early example. At any rate, this is the volatility we are seeing over an historical period in the history of the particular index. The volatility that we are seeing is this little tiny right-hand corner right here. Pretty tiny. Has there been an overall trend lower in volatility? Well, it depends what period you ask. If you look at the period back here, it's not too dissimilar from the first and into the second Bush administration. Over here, I'm referencing, of course, the politicians and the presidents of the United States, because we're going to be talking some more about that. However, from the period, of course, from the financial crisis all the way through to the next 5 years, we saw a phenomenal amount of volatility, at least by historical standards. Throughout the late 90s and through about 2003, 6 or 8 years, also much more volatility. So the question is, do we have here an instance of simply a period of decreased volatility, which has happened before? You can see it right here. From about 1995 to 1996, a longer period than we have here now. Here we're talking about 5 months, December through the end of April. We have a period back here where we have small amounts of volatility. So this is not an unprecedented, as I said in the write-up for this is hardly an unprecedented period. We take a look at the specific currency volatilities in a minute. And it has coincided with the election of Donald Trump here in the United States. The question we have to ask, and I will be asked and answering, is that a coincidence of, is that a function of Mr. Trump's election, or is it a coincidence with which his election fit into the period, but I don't think is not due to it? And we're going to take a look at that and talk about that in a little bit more. So we can see that by historical standards, yes, meaning the overall run of volatility over the past 25 years, essentially my career in the markets. I began when I was 12, of course. So I'm, not that old. The period that we're seeing is, yes, of extremely low volatility by historical standards, but it's also completely precedented, meaning that there have been extensive periods of very low volatility stretching across the history of this particular index. Okay, so that's the 92. This is the 10-year period in the VIX, as it is called by folks in the markets and everywhere else. Okay, so this is, now we're seeing the period here. And it looks a little different when you look at it with this 10-year range. In this, yes, you are seeing that it is a period, again, of extremely low volatility. But what else are you seeing? That more or less over the last 10 years, even including 2008, you could make a credible argument that low volatility had become the norm, even after the gyrations of the financial crisis and subsequent mini crises, which didn't turn out to be too crisis-like, but they were crises. Okay, what do we mean? Well, from 2012, more or less, all the way through 2014, 3 years, you had a period of extremely low volatility, not unlike what we've seen here. So you couldn't really argue that this period has been typical, but you could argue that it's neither atypical nor not normal. That we are simply seeing a period, not an overall trend, but a period where things have not been that volatile. Well, let's go back to June and the great stirrer up of the markets, the Brexit vote. Even with that, and that was Q2, that was right about here, 2016, it was in June. I didn't mark it on this chart, sorry about that. In fact, the beginning, this spike in volatility here, and this spike in volatility here had nothing to do with Brexit. They had to do with China and the devaluation of the yuan and the turmoil, fear, that instilled in world equity markets. That's what is going on here. And I would tend to say that the VIX probably owes more to volatility in equities and perhaps something in commodities than anything else. Okay, hold on a second. Just a minute, hang on one second, everybody. I'm going to turn down, we've got some new lighting in this, and a new microphone, and a new camera, and a new computer. So, we're going wholeheartedly into the new video age here. I'm even going to start shaving regularly. Well, maybe not. Okay. I'm going to answer, we have a question here about volatility. I'll read it out. If I understand correctly, volatility creates moves and trends. So in low volatility market, the market conditions should be range trading and high volatility should be trends. That's more or less true. Can we anticipate the volatility? To some degree you do. Meaning, if you look at it right now, we have a period of low volatility. You have to, of course, assume as a trader that what is going to, the recent past will probably be a predictor of the near future in terms of volatility. Meaning, right here in 2008, when you got this huge spike in volatility because the world was about to end. It didn't, when the world didn't end, and in a crisis like that, which involves so many factors and so many players of all different levels, it takes quite a while for the volatility to die down. So from the spike in the volatility in the late third, early fourth quarter of 2008, it didn't really die down for 2 quarters. 3 quarters, really, if you count fourth quarter 1 and 2. So that's 9 months of relatively extreme volatility. So if you, in that period there, with that enormous spike up to over 88, I think it spiked above 90 on the VIX, you would have to anticipate and you would have to factor into your trading, your positioning, and the type of trades you're going to do the likelihood that every day you show up, the markets are going to be really volatile. That would be the assumption you would make. You would change your parameters on your trading. That's what I would do. You would assume you be looking over your shoulder all the time. I would assume that markets are going to be much jumpier, and they were. They're going to be much more likely to turn day to day. But the other thing you would assume, and I would have assumed, and did actually, that the trends initiated by that volatility, or that coincided with that were engendered by that volatility, were viable trends that would probably stay until the volatility diminished. Meaning, people piled into the dollar because they were terrified. Well, it's going to keep going into the dollar until they're not terrified anymore. You could say a smaller thing during the periods here involving the Greek crisis and subsequent permutations in Europe. The collapse in the euro hits taken, were an emblem of the market's judgment on that. So as long as the volatility, meaning as a picture of the fear, that trend will likely continue. So there are correlations, and they're not so much correlations in that one causes the other, but they both depict an underlying reality in the markets that stays the same. Okay, so I have that. I have a few more questions I'm just looking at. Yeah, you know, there are lots of different definition of what would be volatile. I mean, to my thinking, a volatile market is one where you don't get extreme volatility every day, but where the average range expands. Let me show you what I mean. Okay, I'm going to move to a currency trade here. Okay, let's do the euro over 10 years. Okay, so this is a euro 10-year chart, and then I'm going to get back to what I was talking about. I'm going to answer some of these questions first. Okay, so volatility. This is our current period right here. You can use this as the one thing I wanted to say before. Here, this I want to show you before I go any further. Okay, let's look at the euro 1 year. This is the euro on the 1 year. This is where you have to be careful. Graphics can be almost as deceptive as presented for the argument's sake as statistics. You know, one of my favorite quotes, Mark Twain. If you're ever depressed and if you're an English speaker and you're ever depressed, just go to find a collection of Mark Twain's quotes and read them. They will refresh your faith in human skepticism as a source of humor. So this is a 1 year chart in the euro. And, you know, it sort of looks like we've got some volatility here. I mean, down here it's 103, up here it's 109. We got 6 figures of volatility. We got some pretty big moves here. So if you wanted to show that the markets are still volatile, you could construct an argument based on this chart. Let's take a look at the 10-year. So if you were trying to make an argument that trading is volatile and it's a good thing to do, that you want to use that chart, that's fine. You could do it, okay? Let's look at this chart, 10-year. Kind of puts that chart into perspective, doesn't it? The 1 year goes out to about here. And you can see how different this looks. So charts and visual images are as capable, or more so, of deceiving, or at least serving is perhaps a better way to do it, in the service of any particular argument you want to make. Much as Twain's quote lies in orders of increasing opprobrium, fancy word based in the Latin, lies, damned lies, and statistics. You could do the same thing with charts, only you'd have to do it in reverse order. You would have to put the most accurate charts being the ones with the greatest range. So I guess you'd put it 10-year, 1 year, and I don't know, weekly or monthly, something like that. If you wanted to look at, make a comparison between charts that could be equally deceptive if you're looking to make a particular point. Okay, so back to this chart just briefly. In this chart, you can see the difference in volatility in the periods we're dealing with. Now, part of this is trend related. Okay, this trend right here from 2014 on down, when the euro basically collapsed because the Fed has decided that it wanted to start raising rates again. And not only is there a coincident trend here, now this is the 10-year. Let's look at the VIX 10-year. Remember, we're dealing with 2014. Okay, 2014 here. So there is some sort of coincident spike right here. Oops, so I got to put the chart up. Sorry. It doesn't switch automatically. Okay, so this is the euro. This is the okay, so we're talking about a period of 2014, right about here. Okay, so you can see that there is a spike in the volatility in 2014 that is coincident with, I got to switch back. Hang on. We're coming. We're coming. Okay. That's coincidence with this very pronounced trend in the euro. So currency volatility does have its effect on the VIX, the overall volatility number. But remember, the VIX is an index. It's not really based on any particular measure of the markets. Okay, so not only do you see in this period here both a very pronounced trend, but you also, if you look at the size of the individual candles, you can see that they are much larger, meaning there is much more day-to-day volatility. This is essentially the ideal situation for a trader. You have a pronounced trend, and you have lots of volatility. Dangerous, perhaps, because the volatility means that your trades are going to have a greater than usual variation in P&L. And in a market like that with greater volatility, it's much, much more difficult to pick successful entry and exit points, especially since you're going to put a stop on them afterwards. Nonetheless, this is about as pronounced a trend as you can have. There's one here too, 2008, same reason. I mean, look at the volatility here. So volatility for me is not only one day with excessive volatility, but a longer period, weeks or months, where the average range is much higher than a prior or subsequent period. That's what I think determines volatility. It's not my opinion, it's simply the definition, really. So if we're looking at this period here, from the election forward, and then we compare it to the period the prior year, you can see very easily that the volatility has, and this is the euro, diminished substantially. Now let's take a look at one other. This is the 10-year in the euro. Let's now look at the yen in the 1 year. I'm waiting for our voice-activated computer. I wonder if I get Alexa, you know, that voice activation device from Amazon. My kids think it's hysterical. A friend of ours has one, and they go over there and they try and confound Alexa, which is not very hard to do. But she's actually, or it, but now we're going to have to start calling it she. Are suddenly all computers, the way all boats and all ships are referred to as she? I do wonder if we had a, well, never mind. I'm not going to go there. I'm getting into gender politics is really not someplace I need to go in these webinars. Okay, so this is volatility in the yen in 1 year. Okay, and we see the strong dollar move here with increased volatility, and it looks here that the yen has been relatively volatile in the 1 year. So let's now look at the 10-year. I think you know where this is going. Okay. This is a 10-year. So this is the election period here. And you can see that by any concept of volatility, peanuts compared to what went before. Now we are, of course, we need to differentiate to some degree between trend and volatility. Most of the time you get a pronounced, certainly in the beginning, the advent of a new trend, a reversal, you tend to get very strong increases in volatility. Let's look at the better chart on this one, the Euro 10-year, just to show you about that. Okay, here we go. I'm getting it. Remember, we have to differentiate between trend and volatility. They're not the same. In the beginning of any trend, any reversal, this is the best example right here, 2014, when the Fed started to change its rate policy. This is an even better example, although it's true in almost every currency. You can see that in the beginning, as the markets find a new trend, search out a new trend, volatility rises dramatically. After all, nothing is so conducive to volatility as a rising fear gauge, which is, of course, what the VIX is often referred to as. And the reason, of course, is very simple. Many people, many participants in the markets have a position stake in the old trend. If you were trading euro from here to here, from the third quarter of 2012 through the second quarter, the end of the second quarter of 2014, that's almost 2 years, you had a stake in a long euro position. More of the market, the overall market position during that period had to have been judged and was long euro. Otherwise, the euro wouldn't have gone up. So that means that a lot more people were longer euro than short euro. Yes, the old cliche, why did the market go up? Oh, there are more buyers and sellers. Yeah. Henny Youngman, I'm not. You probably don't know who Henny Youngman is. He was a comedian of the old Catskill days. New York City residents who used to go to the Catskills in the 40s and the 50s and the 60s and the 70s into the 80s for a getaway from New York. And there were a lot of sort of old-fashioned one-line comedians down there who used to perform there as a resort area and as something to do. During the summer, it's largely gone, but it did exist for a long time. And I know people who had houses up there on the fringe of it. Anyway, side story mostly for East Coasters from New York and Boston who knew about that place. So it takes a while and some particular levels, because how will a market change its mind? Well, it changes its mind based on levels until everybody's convinced. So the people that got long here might be willing to wait till here to get out. The people who got long here might be willing to wait here. So the market will work in fits and starts, but establishing the trend, and you can see what happened right here. This little peak here, over here, everybody didn't know the trend because you had several falls before. So you didn't really get a real sense of the trend commencing in reversal till over here, which is almost a quarter into this peak, after the peak. Right here, it was clear that everything was changing, and then it just fell off a cliff. So this period here, when the trend really changed, engendered much more volatility. So when it becomes clear, because the reason for market participation is that when a trend reversal becomes clear, this period here, you could easily see the people who were long stopping themselves out or taking profits, but no one, or at least in general, the market hadn't been convinced yet. Because if you take a trend line from, say, here or here, up here, the market doesn't break the level till that big move that day right there. Okay, I can't drill down on this because these charts are static. In other words, they're pictures. I don't have the. But right here, the trend line back to here skates right through about right here, and that's when you get the big move. The reason you get a bigger move once a trend is clearly broken is because you have new participants. The old trend was supported, or the old trend reversal, to the degree that it had taken place, could be seen as profit taking. People are actually participating in the trend. You don't get any new blood, if you will, they say in auctions, in the market. Once the trend becomes clearly changed, you get all sorts of new people, because after all, if you go short here and here and here and here, you're still making money. So you get a lot of new participation in the trend. That's kind of why trends will move slowly and then all at once when you get a reversal like that. Okay. So let's go back to the 1 year. Actually, let's stay here. Let's stay here. But just go. Well, let me do one other thing on history here. This is, we're back to the euro. Let's take a look on the euro 20. Let's see where we are with volatility. Hello. Sorry, folks, my computer seems to have stalled for a moment. Okay, euro 20, it has recovered. This is basically back to the inception of the euro, right? Euro started trading in 1999, right here at about 1.8. 1999, where's 1999? 1999 is back here. It's about trading about 1.8. What's before this is conjecture, meaning not conjecture, but it's where the euro would have been based on the participation rates that they opened the euro at. So anyway, when you're looking for volatility, when you're looking for trend lines, in the euro or in any other currencies, you need to take the long view to understand where the currency is likely to go. Not to go, but where it's likely to return to with the kind of volatility that, if you're not experiencing it now, is likely to return. After all, the world is not a static place. This 2008 debacle will come again in some fashion or other. There's no regulatory regime of mankind that has been devised or ever will be devised that can prevent human psychology and recurring crises. That is certainly true of the financial markets, and I feel certain that it will be true forever. So volatility will return. So one should not assume ever, as someone said in the beginning of the Great Depression, actually just before the Great Depression, equity prices have obtained a new and permanent level. Well, not really. And that's true of volatility as well. Okay, so let's take a closer look again. I'm going to go back to the euro. I'm going to do the 10-year. And we're going to speculate a bit on what's going on. So I think we've established that volatility, there'd be zero reason to assume that after 4 months volatility has disappeared anyway. I remember long stretches in the 90s, the mid to late 90s, running the Tokyo shift, the Tokyo desk for Credit Suisse in New York. And there were periods, went on for months where there was almost no volatility. It seemed like, you would get 40, 50 point ranges every day, and that was it. And nothing happened. But of course that ended. And we moved on to the subsequent bits of volatility. Okay, so let's look here and see if we can talk about for a bit on the change. Let's do it on the 1 year. And what is going on? Why, considering the changes in less than a year, a little bit more than 3/4 of a year, right? We're in just beginning of May, June. So we have 10 months basically since the British vote. Okay, so the British vote was right here. Okay, right there. That's the British vote right there in June. What have we seen? We have seen the British opt out of the European Union. We have seen the Dutch, aside from the fact that the Greeks are permanently in crisis and no one seems to care anymore, except maybe the Greeks, I'm sure. So you've seen Britain opt out of the European Union. We've seen Geert Wilders fail, as he was expected to obtain the premiership in Holland, but to do much better than he has ever done before. We have seen the French apparently going to give the prize, the presidency, to a supposed independent. Of course, Macron was a minister under Bernard Arnault. He very astutely formed his own party less than a year ago to win, and he probably, because the socialists had a less than 10% approval rating in France, and they still do, and he was a socialist minister. So the markets are already assuming that is not going to take place, meaning that Marine Le Pen is not going to win. Just today, actually over the weekend, Matteo Renzi, the former prime minister, got won again the endorsement and the leadership of his center-right party. And the assumption is that in the next election, which is coming soon, Renzi will run against whoever is in the five-star movement. And the markets are probably betting that that will continue with Renzi. And again in Germany. So all of these potential disturbances seem to be winding down. Both the Brexit vote and Trump's election should have, or not should have, but are disturbers of the peace. Neither was expected to win. Both undermined the consensus judgment of all of our journalists and other elite types. And both potentially would upend the current status in Europe and the United States, not just politically, but of course, economically, financially. Yet the result of both of those elections has been the lowest volatility in several years. Let's take a look again at the 10. This is the VIX. So despite this, the seeming, and difficulty is not the right word, but the seeming ability of voters to undermine the status quo, both in the two main Anglophone countries in the world, the United States and Great Britain. Despite that, the volatility has been the lowest in a number of years. At least now, we could say back to more than a year, more than 2 years, really, back to the beginning or the middle of 2012. So what is going on? You have two votes, and this is not simply because, let's take a look at the 1 year. Okay, this is not simply because the Brexit vote and Donald Trump have calmed down, right? Because it looks as if what you're getting from volatility is simply a vote on surprise, at least in the VIX. So all that's really happened here is that the markets did not expect Brexit to win. The markets did not expect Donald Trump to win. So everybody had to reposition. Every market position in where you want to look, equities, currencies, interest rates, commodities, was positioned incorrectly. So the simple reversal based on that is one that had to be reversed. Now that you have that, you get a volatility. The ongoing negotiations over the Brexit vote, although they have, for England and the continent, a great deal of real difficulty, ramifications, and change, are going to take place in the realm of the bureaucracy. There probably isn't going to be, at least very little, real dramatic change. I mean, it'll be dramatic, but it isn't going to affect the markets very much. It's in rules, regulations, and other things. There isn't going to be any dramatic election. I mean, the great thing about elections is they focus. It's one day. Everybody can focus on it. The difference for Brexit, it's a long, drawn-out 2-year process in which very little of the changes are going to be large and noted. And you could say the same thing is going to be true about Donald Trump's election. The great focus was on the event. Since then, much less. Even the failure, so far at least, of the healthcare vote, the pending changes in the tax code, and any other activity that, political activity, that the Trump administration undertakes, it's a lot like the political and the bureaucratic activity that Brexit will take. Slow, careful, largely quiet, bureaucratic. Not the type of activity that gets markets all in a fluster. So in a sense, there isn't, even though both votes were antithetical to what the markets had expected and to what many analysts thought were the right results. I would venture to say that the vast majority of analysts writing on, and economists writing on the Brexit vote were not on the side of leaving the leaving the European Union. I would venture to say that a large majority, probably not as large as in the Brexit vote, but a large majority of economists and commentators, although less so because the Brexit vote had such large economic ramifications. It was essentially an economic vote in its result. Well, that's not quite true. I mean, one of the reasons that Brexit was so successful because of the other issues that incorporated, but it had more, shall we say, more direct economic content, and also for at least for the people writing out of London, it directly affected the city and their financial wherewithal. The Trump vote is a lot more diffuse, and its the resulting policies will be much wider in application, which means they'll also be far more diluted, as we just saw in the budget that came out. It did not include money, as Mr. Trump had campaigned for, otherwise he's still going to do it, to build a wall on the Mexican border, and it retained the funding for Planned Parenthood. I have no opinion on those that I'm going to talk about here, but just to say that the more radical proposals of the Trump during the campaign were simply not passed. So as the policies become reality, they lose a good deal of their radical issues. So this is also one of the factors involved in the volatility diminishment that we're seeing. Excuse me. Now let's see if this is true also in what I'm going to take as one of the, it's not quite an emerging markets currency, but I couldn't go through many currencies, so I chose the Australian dollar. We looked at the yen and we looked at the euro. Again, it would seem here, 0.7, just on the graphic representation, that we have a tremendous amount of volatility here. Of course, if you look at the legend on the right side, you'll see that you really don't. You have basically 6 big figures here and there over the 5-month period. This actually years over the year, and very little pronounced, very little trend. Actually, we do it better, except for short periods like here to here and here, and no trend. Over the year, there's no trend here in the Australian dollar. Okay, let's look at the Australian dollar in the 10-year. And once again, you can see the very profound difference in graphic representation in the currencies and in the volatility from taking a longer view of what's going on. This is 10 years, a decade in the Australian dollar. And there are some very pronounced trends. Of course, financial collapse, recovery. And Chinese right here, in particular, Chinese currency problems, and again, right here. So again, this volatility is not emblematic, is not typical of the majors or the major minors, as in the Australian dollar. Here's a 20-year on the Aussie. Same issue. Pronounced trends. And as you can see, in many trends, once the initial fear wears off, if you get a reversal like that, now you see the difference in these, in between this reversal right here and this reversal right here, is the way the reversal came about and the entire volatility universe of the 2 periods. The volatility from here to here, even in the reversal period right here, this period right from here, it's reversed, is minuscule compared to what we have here to here and here. This is much more emblematic of a normal business cycle reversal, of a normal central bank monetary policy counter-cyclical approach to a central bank monetary policy. The volatility here, of course, is of an entirely different order. If you look at this period from here to here, or take it from here to here, right, where you have the same range. So in the Aussie dollar, from here to here, you go from the bottom here back in 2004, say the beginning of, just say the beginning of 2004 to here, which is more than 4 years later. To get, for the market to get from here, just approximately here to here, took 4 years. The same distance range during the financial crisis went from basically through the first quarter, the last quarter of, say, 2 quarters, the fourth quarter of 2008 and the first quarter of 2009. So in the same range from here to here, which took 4 years, financial crisis did it in 2 quarters. So that's the change in volatility. And I don't know if you want to call this a trend or a plummet. This is a trend. A trend engenders, in general, less volatility because the markets aren't all excited. They're not all fearful. They're not all rambunctious about what's happening. And you're dealing with the types of incremental changes that are typical of currencies responding to the differences in both central bank policy and economic growth. That's the 10-year trend there, or the 6-year trend from 2002 through 2008. So this period, where you're looking at the type of change that I'm talking about, basically economic and financial policy, is similar to what we have here. The volatility is lower because you're looking at changes. Once you have the event taken care of, you're looking at past, if you will, finished. You're looking at changes in the economy, in political implementation, rather than in political gamesmanship or political jockeying or in elections. We can't say that the reason volatility has, because if you just look at the surface on the change, it would appear that there should still be, you could make a case there should be a great deal more volatility because Trump's going to do to some degree what he said he would do. And he's certainly trying. And the same with Brexit. The resulting change will be to take Britain from the EU, sort of. I think what we're seeing is that both changes, both election results, the markets are anticipating a rather serious watering down of the rhetoric from the campaign, from both campaigns. There are huge impediments to change, not the least of which is simple inertia in all countries, in the economies of all countries, in the political systems of all countries. Relatively speaking, revolution is rare. Even the type of revolution or the type of revolutionary campaign, meaning how it was conducted more than anything else, that Donald Trump ran is just a campaign. Markets taking the long view, or at least the longer view, starting with the credit markets, are not taking these two events as dramatic changes in volatility. So this is the real difference that we're seeing in the change in volatility. It's the event and the shock of the event that spikes the volatility. And no matter, it's not the substantive result. Because if it were the substantive result, both of those examples have remained. The British are still going to lose Brexit, and Donald Trump is still president. So if that was the source of the silence, excuse me, if that was the result or the source of the volatility, if it was the substantive change in the position of Britain vis-a-vis the EU, and in the substantive change in U.S. economic and political policy vis-a-vis the new administration of Donald Trump, if it was the substance of those events that were driving volatility, logically, should not have changed. It shouldn't have gone down as much as it did. Because those changes are going to take place to some degree, and certainly to a much greater degree than they would have had the election gone the other way in both those cases. So volatility is really a measure of, as they put it on the VIX, event-driven fear in the markets, which is a much narrower definition than overall volatility. So you should never confuse the two, and neither one of them is the consideration of a trend. In fact, trends, long-term trends, tend to be a lot less volatile than their reversals and in the types of event-driven market panics that we've seen at various times over the past 10 years. So when you're looking at volatility, make sure you keep in mind both the different origins and the different predictions that you can get from volatility. Don't be fooled by the numbers. Okay, folks, I'd like to thank all of you for attending. I hope this was fairly useful. We have a market directions interview this week with the father of candle charts here in the United States and really in the world, and that is the inestimable Mr. Steve Nissen. And we'll be doing that on Wednesday, although it might possibly change to Thursday. I think it's going to be Wednesday. We're also going to be doing another roundtable, not really roundtable, but panel, I believe with Ashraf Lady, Martin Armstrong, and myself about the French election this coming Sunday. So a lot of video activity going on these days. I hope you all attend. Again, I'd like to thank Dedinda and Maurizio from FX Street for their help and support in putting on these videos. And I thank you all for attending. It's Joseph Turv, Center for Worldwide Markets. Everyone have a good day.